Most people do not have a portfolio, they have a pile. A few stocks bought because of a headline, an ETF someone mentioned, a bit of crypto from a good week. And here is what that pile hides. You can own 6 different funds and still have a huge share of your money riding on the same handful of companies without ever choosing that. A real portfolio is different. Every position has a job. So here is a 5 layer structure where each layer answers a different question. Before we begin, the disclaimer, and today it matters more than ever. I am not a financial advisor, and this video is for education and entertainment only. Nothing here is investment, tax, or legal advice, and absolutely nothing here is a recommendation to buy or sell any security. This is a framework for thinking about portfolio construction, not a model for you to copy. Investing involves risk, including the loss of your capital. Past performance does not guarantee future results. I may hold some of the assets discussed. Always do your own research and consult a licensed professional. And welcome to the channel. Here we go deep. We don't do surface level tips or hot stock picks. We break down the real mechanics that move markets and the money inside them. Today is our most ambitious episode, a complete portfolio framework built in 5 layers, each with a clear job. Not a list of tickers to copy, but a way of thinking you can apply to your own situation. Most retail portfolios are not really portfolios at all. They are a pile of stocks someone bought because of a headline, a tip, or a feeling, with no structure tying them together. The result is usually hidden concentration, no clear role for each holding, and no plan for income or for downturns. A real portfolio is different. Every position has a job. So today we will build one conceptually in 5 distinct layers and reason through why each layer exists. And before we build anything, we should look at the problem underneath the problem because it is the one almost nobody checks. It is called look through concentration. Say you own a broad market index fund, a technology fund, and a handful of individual large companies you like. On the surface, that looks diversified, 3 different products. But index funds are weighted by size, so the largest companies dominate all of them at once. The same few names can sit inside every fund you own, plus the individual positions you chose deliberately. Add it up, and a portfolio that feels spread out can have an enormous share of its value riding on a very small number of companies. You did not decide that. The weighting decided it for you. So the first job of any structure is simply to make what you actually own visible. Here is the whole structure before we zoom in. Layer 1, individual growth equities, the highest conviction companies. Layer 2, growth ETFs, broad baskets that diversify that growth. Layer 3, an income engine, holdings whose job is to generate cash. Layer 4, a small allocation to crypto as an asymmetric bet. And layer 5, an opportunistic sleeve for special situations. Each layer answers a different question, and together they balance growth, income, and risk. Layer 1 is the engine room, a focused set of individual growth companies. The thinking here is to own a small number of dominant businesses with real competitive moats in structural growth areas like artificial intelligence, semiconductors, and cloud computing. Think of the kind of companies that design the chips, run the cloud, and own the platforms billions of people use. The bull case is that these winners keep compounding. The bear case is just as important. They are richly valued, crowded, and a disappointment can fall hard. This layer is where the most homework is required. The key discipline in layer 1 is not which names you pick, it is position sizing and conviction. A concentrated set of individual stocks is the highest risk, highest reward layer, so it demands the most research and the clearest reasons for owning each one. The honest question for every single position is, do I understand this business well enough to hold it through a 50% drop without panicking? If the answer is no, it does not belong in this layer. Layer 2 wraps that individual stock risk in diversification, broad growth ETFs. If layer 1 is a few sharp bets, layer 2 is the steady base, owning whole indexes so that no single company can sink you. This is where you capture the market's overall growth cheaply. The discipline we covered in earlier videos applies directly here. Watch for overlap between these funds and your layer 1 stocks and keep the fees low because over decades fees quietly compound against you. Layer 3 has one job: generate cash. This is the income engine, and it is where everything from our covered call and high yield videos comes together. The thinking is to hold quality income producers, judged strictly on total return and payout coverage, not headline yield. The purpose of this layer is not to get rich, it is to produce a growing stream of cash that can be reinvested while you build or drawn on later, and to add a different return driver from pure growth. Layer 4 is small, deliberate, and controversial, a modest allocation to crypto, primarily the largest and most established names. The thinking is asymmetry, a position small enough that losing all of it would not hurt the portfolio, but large enough that an outsized gain would matter. The bull case is a genuinely new asset class with scarcity and adoption. The bear case is brutal volatility and regulatory uncertainty. The discipline is simple: size it so that an 80% crash in this layer is survivable and almost boring. Layer 5 is the opportunistic sleeve, a small bucket for special situations, beaten down quality names, turnaround stories, or emerging companies with a specific catalyst. This is the most active, most speculative layer, and it is deliberately kept small. The point is to have a defined, limited space for higher risk ideas, so they scratch the itch to act without ever threatening the core. When a speculative idea is walled off in a small sleeve, a loss is a lesson, not a catastrophe. Now step back and see why the structure works. The layers are ordered roughly from foundational to speculative, and the sizing should follow. The broad, diversified layers form the bulk. The concentrated and speculative layers are the minority. This way, the boring layers carry the portfolio, while the exciting layers add upside without being able to sink the ship. Diversification here is not just across companies, it is across roles: growth, income, asymmetry, and opportunity. So, how much belongs in each layer? I am not going to hand you percentages because the right answer depends entirely on your age, your income, your timeline, and how you actually behave when things fall. But the principle is not personal at all, and it is this: the layers are not equal, and they are not supposed to be. The foundation, meaning the broad, diversified holdings and the income engine, has to be large enough to carry the risk takers sitting above it. The speculative layers, the crypto, and the opportunistic sleeve should be sized so that losing all of them is survivable and ideally boring. Here is the test. If a total loss in your smallest layer would change your life, that layer is too big. That works at any portfolio size, and it does not require anyone to hand you a number. A portfolio is not a one-time build, it is a system you maintain. As layers grow at different speeds, your percentages drift. Rebalancing is the discipline of trimming what has run hot and topping up what has lagged, pulling you back to your target weights. Done with intention, it quietly forces you to sell high and buy low, and it stops any single layer, especially the speculative ones, from silently taking over your whole portfolio after a big run. There is a second question underneath allocation that most people never ask, which is not how much, but where. Different account types are taxed differently, and different layers generate different kinds of taxable events. The income engine, by design, throws off distributions constantly, so it is the layer that benefits most from sitting inside whatever tax sheltered or tax advantaged account you have available. Broad index funds you intend to hold for decades generate very little until you sell, so they sit comfortably in an ordinary taxable account. The specific rules differ substantially between the United States and Europe, so the details are yours to check for your own situation. But the principle travels everywhere. Put the layer that generates the most annual tax drag in the most protected place you have. Now, the failure modes, because a framework that only works in theory is not worth much. Four things break this. One, layer creep. The speculative sleeve has a good year. You do not trim it, and quietly it stops being small. Two, never rebalancing, which is the same failure wearing a different name. Three, adding a sixth layer, then a seventh until the structure is just the pile again in a costume. And four, the subtle one, holding something in the wrong layer. A speculative company you have started calling a core holding because it went up is the most expensive mistake on this list because you will size it like a foundation and it will behave like a bet. And a practical question, because almost nobody is starting from cash. If you already hold a pile, you do not fix it in one afternoon. Selling everything to rebuild cleanly can trigger a tax bill that costs more than the disorganization ever did. The gentler approach is to map first and sell almost nothing. Assign every existing holding to a layer, including the ones that do not fit anywhere, because that in itself is information. Then direct new money toward whichever layer is underweight, and let your contributions do the rebalancing for as long as they can. Sell only where a holding is genuinely wrong, rather than merely inconvenient. Structure imposed gradually is still structure. Here is why this whole approach matters more than any individual pick. A tip gives you one decision. A framework gives you a way to make every future decision. When a new opportunity appears, you do not ask, is this a good stock in isolation? You ask, which layer does this belong in, and do I have room for it? That single shift from collecting tips to running a system is what separates a genuine investor from someone just holding a pile of stocks and hoping. To wrap up, a portfolio worth considering is not a random pile of stocks, it is a set of layers, each with a job. High conviction growth, diversified growth, an income engine, a small asymmetric bet, and a small opportunistic sleeve, all sized so the foundation carries the risk takers. Check your look through concentration so you know what you actually own rather than what you think you own. Put the income layer where tax hurts least, and rebalance with new contributions before you rebalance with sales. This is a framework to think with, not a model to copy. Take what fits your own goals and your own risk tolerance, and build something that is genuinely yours. None of this is a recommendation. If this gave you a better way to think about your whole portfolio, do me one small favor. Tap like. It genuinely helps more investors find this. Share it with someone whose portfolio is currently a pile. And subscribe because we do this properly every week. We do the digging so you do not have to guess. See you in the next one.